is all about Bitcoin, a show dedicated to all things questions and markets related to Bitcoin, little b for the currency, and Bitcoin, big B for the network. A collective journey to understand, apply, and use this innovation, all Bitcoin, all the time. And I'm your host, Christine Lee, live from the conference floor of the SALT conference in New York City. Let's have a live look at Bitcoin right now, checking in on the CoinDesk Bitcoin XBX index, currently trading at $48,068. Bitcoin is slightly up about 3.3% over the past 24 hours. And some of our top stories of the day: crypto exchange Coinbase selling about $2 billion worth of debt via junk bonds, up from an initial target of about $1.5 billion due to some strong market interest. Now, the move highlights crypto's evolution from a fringe asset class to one under the spotlight in mainstream finance. And joining me now to discuss is John D'Agostino, head of strategic partnerships at Coinbase Institutional. Welcome to the show, John. So we're reading about this latest news. Junk bonds at 7 to 10-year bonds sold at interest rates of between 3.4 to 3.6%. There seems to be a lot of demand, and I wonder, where is this coming from?
Well, I think we're now seeing what's been talked about for a number of years, the broad base, both retail and institutional acceptance on a global basis, not just U.S., of not just Bitcoin, but this entire asset class, Bitcoin being the bellwether entity, obviously. But we've been hearing stories about institutional waves of capital coming in for some time, and it's being realized again, at both a retail level and a institutional allocator level.
Now, that is a theme definitely at the SALT conference. We're seeing a lot of hedge funds, PE firms, capital allocators talking about crypto. If you walk down these halls, a lot of crypto companies, names like FTX, Circle, Solana, just to name a few, NYDIG, having huge booths. So when your conversations at the conference, what are hedge fund managers, allocators asking you about?
Sure. It shouldn't surprise anyone that actively managed closed-ended, open-ended funds, hedge funds, private equity, VC, anyone who takes in people's money and wants to make more money out of it are constantly searching for new sources of alpha. We know that over the last 11 to 15 years, there's been a degradation of alpha in those traditional asset classes. We have the numbers, we have the performance on an annual basis, and so when you have new markets, new asset classes, new mechanisms, new ways of trading, whether it's the origins of high-frequency trading, 8 years ago or 9 years ago, opening up new markets abroad, or entirely new asset classes like we have with the digital asset ecosystem, it's not only entirely predictable, it should be expected that those who are paid to produce alpha would research and search out those opportunities. So it's just a matter of that infrastructure being ready to accept institutional quality capital, regulated capital. And now that it's here, because of companies like Coinbase, it's an institutionally acceptable asset class, and it's perfectly normal that they would experiment with it and start to engage fully.
So are you getting a sense, are they in the stage of just exploration, or are they ready to write checks? And if so, what kind of allocations are they making?
Again, in general, take a typical hedge fund. Usually the documents allow for anywhere from 1 to under 5% outside of the core mandate, right? So a hedge fund that's an equity long short hedge fund, for example, would be generally allowed to trade under 5% in credit, for example, without having to go back to their investors and say, we've altered our mandate. So that's a good range for what we will call experimentation. Coming in at at less than 1% allocation usually isn't worth the time it takes to sign up the new accounts and whatnot. And then over 5% generally, if that's not in your documentation, you have to go back to your investors and say. So that's about a expected range. And then once they get comfortable with the asset class, they can make a decision. Do we want to increase exposure and then get permission from our investors if our documents require that, or maybe launch an entirely new fund vehicle? Again, and both of those we're seeing more and more often.
I wonder, what kind of client is your typical client? And we've heard some news, PNC, MicroStrategy, and they just this week bought 5,050 new Bitcoin. So what does a typical client look like?
Here's the great thing. Here's how you know the asset class is becoming truly institutional, because there isn't a good answer to that question. What I mean by that is there's a difference in market liquidity, and that's my expertise. Coinbase brought me in because I know exchanges. I was head of strategy for the New York Mercantile Exchange, and I saw that asset class go from not institutionally acceptable to institutionally acceptable over multiple decades. Cryptocurrencies have truncated that acceptance range into less than a decade. And so what I mean by there not being a right answer is, if you have a market that is deep but not broad, meaning there's lots of volume, but you don't have a diversity of participants. There's one type of participant. That's problematic. So if I were able to answer that question easily and say a median cryptocurrency investor is XYZ, I think you would be able to discern that we have a problem with the underlying depth and breadth and liquidity. The best answer to that question is it varies. It ranges from original OG cryptocurrency whales. It ranges to looky-loos who come in and just want to experiment in the asset class. It's individuals who are Bitcoin maximalists who are very excited about the deflationary aspect of the currency. It's people who want to experiment in the asset space. It's people who are approaching it on a market neutral basis. It's hedgers, it's speculators, it's commercials, it's retail, it's institutional. That is what we're seeing now. And that is a true broad and deep market that is both institutionally acceptable, and then the offshoot of that is it's better for the retail market because it's less prone to massive gaps up and gaps down.
Right. And are you offering them Bitcoin or other altcoins?
So I'll get this wrong and get fired probably, but it's many coins. I think it's about 240 coins at one point, but please don't hold me to that. Go to our website and take a look because it's being updated all the time. But again, it's about depth and breadth. It's about offering a diversity of options for both institutional and retail investors.
Right. I would be remiss not to mention this, but obviously Coinbase CEO Brian Armstrong has mentioned very publicly his dismay over the regulatory environment in crypto right now, saying that the SEC hasn't been very forthcoming in some of their positions regarding a yield product that Coinbase is offering. They want to offer lending at a 4% annual percentage yield. They've been given a Wells notice, which is an intent to sue, and they're saying that they haven't been given a thorough explanation as to why they've been given this notice. And I wonder, does that have any impact on the institutional side?
So the short answer is the institutional side is growing. It's growing rapidly. Exchanges are essential parts of critical economic infrastructure. After 9/11 in New York City, two of the businesses that were rushed to open first were the New York Stock Exchange and the New York Mercantile Exchange. So it's natural that as exchanges grow, they will be working very closely with government and with regulators to make that happen. And the technology usually leads ahead of the regulation, and that'll be a dialogue. So to answer your question specifically, it has not slowed down or hurt the institutional outreach around the launch of Prime. I think those are very separate issues, and that's one is a natural evolution and discussion, and the other is the introduction of a product that is desperately needed right now to a market that's hungry for that product.
Hungry for that product. And I have a bit of more of a philosophical question for you, if I may. There are a lot of great products being offered to access this financial system, this digital financial system. And there is potentially a bit of frustration that it may not be accessible to retail investors that have the knowledge to be able to understand these products. What are your thoughts on a knowledge-based access to these products versus a wealth-based access to these products?
That's a great question. Now, this is my personal opinion. I'm not speaking on behalf of Coinbase at all. We have different models, right? In Europe, there's a knowledge-based or an opt-in, opt-out model. Effectively, what you're doing when you opt in to being treated like a sophisticated investor is you're opting out of certain legal protections, right? The bar is higher to sue. The bar is higher to get recourse when you're considered a sophisticated investor. So I think it's the will of the people. We live in a country that's decided to go in the direction of wealth. Now, it's pretty clear from certain moves that the SEC has made that they seem open to the idea of some type of hybrid model because we had an expansion of the accredited investor rule. But I think that's a congressional issue. We have to decide what type of country we want to live in. We've chosen to go in one direction. I think we're the envy of the world to some degree in terms of investor protection. So I think that's it'll be decided amongst voting into Congress and then Congress informing the SEC. But I think the hybrid model seems to be a reasonable one. Wealth is an indicator that you can lose a certain amount of money without it hurting you or hurting the economy. And then also clearly knowledge and sophistication should play some role in that.
We'll see how it rolls out as the regulations.
I can tell you this, that countries that have one or the other, no one has a perfect model. The countries that have purely knowledge-based model have issues as well. So I don't think there's any one right answer to this.
Well, we'll see how it plays out. John, such a pleasure to have you on, and looking forward to seeing Coinbase earnings as they come up in the third quarter. Appreciate you coming on the show. All right, that was John D'Agostino, the head of strategic partnerships at Coinbase Institutional.
The chart of the day is brought to you by Crypto.com, the world's fastest growing crypto app.
All right. Bitcoin has formed a golden cross on its daily price chart, a rare but closely tracked pattern that generally occurs when an asset is on an upswing. The golden cross is a momentum indicator defined as the point at which the 50-day moving average price average crosses above the 200-day moving average. It's a sign that the short-term price trend is rising faster than the long-term trend. The appearance of the golden cross, you see that there, encircled in gold, marks a dramatic comeback for Bitcoin since a death cross appeared in the price chart 3 months ago. At the time, Bitcoin was descending from the all-time high near $65,000 reached in February. A few days after the death cross, the price fell to $28,600, close to the 2021 low. The death cross is when the 50-day moving average falls below the 200-day moving average. And the golden cross is generally regarded as a positive indicator, according to investment research firm Fundstrat. But CoinShares strategists also warning traders that they should be cautious, saying the indicator hasn't been a consistent predictor of positive returns. All right, and earlier I had the chance to speak about the crypto markets with Scott Friedman, partner and co-founder of JST Capital, a crypto services firm based in the United States and Singapore. Have a listen.
Will be between 25 and 50,000 all year. We still kind of think that. We do expect maybe by the end of the year you'll see a bit of a breakout, but there'll be volatility. It's just the nature of the asset. It's a very retail-driven market. We do expect, though, more and more demand to come into play. Recently, Interactive Brokers announced that they're offering it out to their clients, and as that continues to accelerate, we think that continued demand, honestly, will only be good for the market.
And at Salt Conference, are you seeing that in your conversations with investors, with hedge funds and such, that there is that demand? And how do those conversations go?
You know, I think a lot of it starts at Bitcoin. They'll talk to you a little bit about the markets in Bitcoin, but honestly, a lot of the investors have moved past that in certain respects, especially people who want risk and want yield. Right? So the bigger funds, yes, they're comfortable with Bitcoin at this point. If they've allocated, if they want to allocate, they've already done it in certain respects, or they're starting to increase their allocations. But what we're seeing more of is people who have dipped their toe in the water with Bitcoin or even ETH. They're now saying, all right, now where do I go? What's the next? What's the next
thing? So where do they go? What are you advising them?
A lot of these people now are going to things like Solana. Solana's been big this year.
They had a huge network failure.
They did us some challenges yesterday. They were down for 20 some odd hours, and we were a bit surprised that it sold off a little bit. They didn't sell off as much as we had expected, and it's bounced back a little bit today. But they are starting to look for other opportunities like that they think are a little more, give them a little more exposure to the crypto ecosystem, especially in DeFi. DeFi is still hot, and we think people are looking for opportunities in the DeFi space, especially if they're comfortable with the risk.
What protocols in DeFi are you particularly interested in?
Well, despite yesterday's issues with Solana, we like Solana a lot. We like Curve. We like Convex. So there are things like that we think are well positioned to take advantage of the technologies and have a good team behind them and are getting some nice support in the market.
Interesting. And there is that appetite for that among the hedge funds that you're talking to.
They're starting to get more and more interested. You know, we're talking to people. We have clients who have invested with us in DeFi. We have some managed accounts we're doing for clients and things like that. I think traditional funds are still a bit cautious around it, but I think some of the family offices and smaller hedge funds that understand the technology can get comfortable with it.
Pivoting back to Bitcoin, I know you actively trade, JST Capital actively trades for hedge funds, your own order book. So when you see Bitcoin trading in this tight range-bound area, what are you doing in this time?
Well, essentially, folks like us are typically a long volatility fund or our company. So what that means for us is we like volatility. The more volatility, generally, the better we do in the markets, the better our clients do in the markets. So when things are range-bound, those volatility strategies are a bit challenged. People also trade basis in this market, as you know, right? So whether it's trading the perpetuals or the futures, things like that, they have come off a little bit as well. We think a lot of that is just a result of the deleveraging in China and what happened there over the last few months. Unclear if that will ever come back. But you know, these are a bit challenging markets if you're just focused on how do I make money trading Bitcoin.
What kind of headwinds are you seeing with the regulation, with regulators in the United States? We have Gary Gensler making comments before the Senate that there's an investigation to DeFi. They're looking at Coinbase, sending them a Wells notice.
Yep. It's really interesting. As a former lawyer, like, you have some perspective. I used to be a lawyer at the Federal Reserve in New York, so you have some context of what their perspective is and what lens they're looking at these markets through. It's challenging, right? Because the regulatory issues are a bit gray, right? You have what is a security, what's not a security. And it's interesting to me in 2021, we're still having that discussion, right? And it's really strange, right? We had this discussion 5-6 years ago. There's still the lawsuit with Ripple out there, the recent announcement with Coinbase and the Wells notice. That's very, very interesting. And the sooner those things get resolved for all of us, the better.
Right. Yeah. Some say that this is a new asset class and maybe 100-year-old Howey test shouldn't apply, or something new should apply to cryptocurrencies.
Yeah, I think that's a really interesting idea, and we're in favor of just taking a fresh look at the space. What is an asset? What is a loan? What is an asset-backed security? Those are really interesting things. But you pivot from there and talk about the compliance issues, the KYC, the know your customer issues around DeFi protocols. That's a whole separate area that people are still struggling with.
And do you see that as a headwind for Bitcoin? Or
I think it is a headwind for Bitcoin in some respects because it just affects the whole ecosystem. Like, for example, there's a challenge for hedge funds. Sometimes they can only invest in assets or places that have custody, that have really a regulated custodian behind it. And that's a bit challenging still in crypto. And especially as you get away from Bitcoin, they can't hold those assets because you can't hold those assets in a registered custodian. So all those things are headwinds for the market, but they also provide opportunity.
A couple of hurdles to get over there. At the beginning of the year, your prediction for Bitcoin was about 20,000 to 50,000. Right. It certainly surpassed that at some point. So I wonder, what is your end of year prediction?
We still think probably 25 to maybe 60,000 in that range. It's a broad range. We tend to think that going into the end of the year, you'll see some momentum, especially across Bitcoin and ETH in particular. And we expect that just to continue.
That was JST Capital partner and co-founder Scott Friedman. Moving on, the battle to win a Bitcoin ETF approval in the United States is heating up. Fidelity Investments privately meeting with the SEC officials last week to approve its Bitcoin ETF, according to recent filings, citing increased investor interest in crypto and similar funds worldwide. Asset manager Bitwise also joining the battle to win Bitcoin ETF approval in the U.S., customizing their filing to include Bitcoin futures in line with signals from SEC Chair Gary Gensler on Tuesday. And joining us now to discuss is Matt Hogan, Chief Investment Officer of Bitwise Investments. Welcome to the show, Matt.
Thanks for having me.
All right, so you filed recently this Bitwise Bitcoin Strategy ETF with the SEC on Tuesday. Bitwise teaming up with ETF Series Solutions in its bid to get a U.S. Bitcoin ETF over the finish line. Tell me a bit about this product.
Sure. I'm so limited in what I can say about this product because of the quiet period, but I can talk about a Bitcoin futures ETF in general. Investors have been wanting exposure to Bitcoin and crypto through an ETF structure for a long time. And people have been working on it since 2013 when the Winklevoss twins filed the first application for a Bitcoin ETF. There's now at least some signals from the SEC that they're interested in reviewing futures-based ETFs, and that's why you've seen a large number of companies, including Bitwise, file for this exposure. Generally speaking, all the funds will use Bitcoin futures and maybe other products to attempt to capture some of the returns of the Bitcoin market. It will be an exciting new tool in an investor's toolbox for gaining exposure to this market.
So Gary Gensler has indeed signaled that he's more interested in Bitcoin futures exposure related ETFs versus ETFs that are exposed to directly to Bitcoin on the spot markets. So I wonder, how optimistic are you that this might actually get through? Because so far, of course, in the United States, a Bitcoin ETF has not been approved.
Yeah, well, I think, as you know, many novel ETFs take many years to be approved. The first levered ETFs took over 6 years to be approved. The first non-transparent active ETFs took 10 years to approve. So just because it's taken a long time at Bitcoin doesn't mean that the road doesn't end eventually. And I do think we're getting much closer. I don't know.
How soon?
Oh, that's a hard one. Hard to put me down. I think there's a reasonable chance you could see the approvals this year. The first filing would go effective sometime in mid-October. And whether that gets delayed or not, I'm not sure. But I do think we're on or close to the finish line on a Bitcoin futures ETF.
Are you speaking to regulators to get sort of a sense?
Most of my read of this has come from public statements, the same statements that you're looking at. Bitwise has met with the SEC many times to talk about the crypto markets in general and Bitcoin ETF specifically over the last year. But I'm reading the same public comments you are. And I'm also reflecting the fact that this market is simply more institutional today than it was before. The CME Bitcoin futures is a large, robust market with institutional investors operating in that market. The liquidity of that market has improved significantly. So even from an outsider's perspective, looking in on the Bitcoin market, it looks a lot more institutional today than it did in 2017. And I think that augurs well for approval, although, of course, you never know what's going to happen.
All right, and I'm wondering about the first mover advantage here, because in Canada we did see with Purpose Investments when they launched their Bitcoin ETF, they saw explosive volume and it kind of dwindled from the second and third iterations of ETFs there. So do you think that, I don't know if you have any hints as whether the SEC may approve ETFs if they do in a chunk or one by one?
Mm-hmm. I don't know. I don't know. Obviously, they should approve ours first. No, I'm just joking there. Yeah, I think there's a lot of debate on whether it should be one by one or they should batch all the issuers and have them go to market. I will say, usually in the ETF industry, first mover matters a great deal, and it's hard to overcome that. I think crypto may be a little bit different, and here's why. The primary user of a Bitcoin ETF is going to be a financial advisor. And it's one thing to buy that ETF, but it's another thing to hold it for a long period of time and answer the questions that your clients have about the crypto market. What does this new regulatory development mean for my ETF holding? I think you're going to see over time advisors favor firms that have in-depth research that can help them answer the questions that clients have. So maybe that's more important here than it is in a more familiar market like equities or traditional commodities. I think advisors want that support.
Nevertheless, there are several Bitcoin ETFs awaiting approval. Van Eck is the latest one that they'll have it expire if they don't get approval in November. Any chance of any of those or not? Because the Van Eck one is, of course, exposure is to the Bitcoin spot market.
It's so hard to keep track of these because there are two different roads that are going here. You have the futures-based road, where the first sort of approval deadline is mid-October, and you have the physical or spot Bitcoin ETF, which is the Van Eck one you mentioned. I think the indications from the SEC's public statements is they're particularly excited about reviewing the futures-based ETFs. I personally think the market is ready to support both. But I don't get to make those decisions. The folks in Washington do.
And last question, I just want to slip in there. You also have an ex-Bitcoin fund counting exposure to every coin except or a bunch of coins that are not Bitcoin.
Yeah.
Tell me a bit about this, but again, it is only offered privately.
That's right. Last week we launched the Bitwise 10 ex-Bitcoin Crypto Index Fund. There is huge demand for it. One of the biggest stories in crypto over the last year is that professional investors who first went into crypto in 2020 by buying Bitcoin are now looking at what's happening on Ethereum, in DeFi, in NFTs, and they want exposure to that too. So this fund starts with Ethereum and holds the next 8 largest assets for a portfolio. That's Cardano, it's Solana, it's DeFi assets. It makes it easy to gain exposure to everything else beyond Bitcoin. And yeah, we've been surprised by the amount of demand.
All right. Matt, appreciate you coming on the show. Good luck on this latest ETF filing. I hope one of them gets approved one of these days. There are currently 10 Bitcoin ETF applications pending approval in the United States. Matt, thanks for joining us.
Thanks for having me.
All right, that was Matt Hogan, Chief Investment Officer of Bitwise Investments. That is it for All About Bitcoin, and this is the final day at this conference. We'll be back in the studio tomorrow morning at 9 a.m. for First Mover in New York, your first global look at today's global crypto news headlines. I'm your host, Christine Lee. You're watching CoinDesk TV.